Hey everyone, welcome back to Corporate Decoder. Today we're diving into Blue Owl Capital Corporation's latest filing, and let me tell you, it's a real hoot. It's going to be a wild ride, but, hopefully not too wild for them. In short, Blue Owl is looking to sell more of its common stock, up to $750 million worth. They're doing this through something called an at-the-market offering, which basically means they'll sell shares over time through sales agents, adjusting to the market as they go. Let's get into what all of this actually means and why it matters. Blue Owl's main goal is to make money for its investors primarily through lending to and investing in US middle market companies. Think of businesses that are big but not huge. They aim to generate current income and some capital appreciation, which means they want steady returns and ideally some growth over time. They're picky about who they lend to, looking for companies with solid returns for the risk they take. So, who exactly are these middle market companies? Blue Owl typically targets businesses with earnings before interest, taxes, depreciation, and amortization, or EBITDA, between $10 million and $250 million a year. They might go smaller or bigger if the opportunity looks good, especially during times of market craziness. Blue Owl invests in different kinds of debt, from senior secured loans the safest to mezzanine loans riskier but with potentially higher returns and even some equity. A lot of this debt isn't rated by agencies, but if it were, it would probably be considered junk, meaning below investment grade. They are taking on risk for potentially higher rewards. Now, a bit about how Blue Owl is structured. They're a business development company, or BDC, which means they have to follow certain rules under the Investment Company Act of 1940. They're also aiming to be a regulated investment company, or RIC, under the tax code, which lets them avoid corporate income taxes if they distribute most of their income to shareholders. Basically, they're set up to pass the profits on to investors. As of February, the last reported sales price of Blue Owl's common stock was $15.53 per share. It's important to remember that the market price can fluctuate, and shares of these types of companies often trade at prices lower than their net asset value. So keep an eye on that. The way Blue Owl plans to sell these new shares is through an at-the-market offering. This is not your typical initial public offering, and they will slowly sell shares through different sales agents like RBC Capital Markets and Truist Securities. These sales agents are getting a cut up to 1.50% of the gross sales price for any shares they sell. So for every $100 of stock sold, they get up to $1.50. Here's a good thing: Blue Owl says they won't sell the shares for less than the net asset value per share at the time of sale. However, we've seen cases where this rule is bypassed through some clever accounting to benefit insiders. Anyhow, Blue Owl's investment advisor may step in to cover the commissions and ensure the price stays above the current NAV to avoid issues. This document is a supplement to an existing prospectus, so make sure you are reading both documents, and if something in the new supplement disagrees with the old prospectus, then you should trust the new supplement. A lot of this filing contains forward-looking statements, which are basically guesses about the future. Words like anticipates, expects, and believes should be taken with a grain of salt. There are risks and uncertainties involved, and things could turn out very differently. So don't put too much faith in these predictions. Speaking of risks, there are a few big ones to watch out for. An economic downturn could hurt Blue Owl's portfolio companies, leading to investment losses. Rising interest rates and inflation can also mess with their business, especially since they use leverage or borrowed money as part of their investment strategy. There's also the risk of losing key personnel, competition for investment opportunities, and the uncertainty of valuing some of their investments. Remember, the war in Ukraine, instability in the banking system, and a new presidential administration also add to the uncertainty. There's been some big news recently. Blue Owl acquired Blue Owl Capital Corporation 3, or OBDE, in January, issuing a ton of new shares to do it. This is considered an asset acquisition. The old OBDE assets were bought at fair market value. They also changed their investment advisory agreement to exclude any purchase premium or discount from the calculation of incentive fees. It is not clear how this will affect their finances, but be aware that these new terms exist. So, what's Blue Owl planning to do with all the money they raise from selling these new shares? They expect to use it to pay down some of their existing debt under their revolving credit facility, so they may not be planning to use the money for growing as much as simply avoiding debt. Speaking of that facility, the interest rates they are paying on it are variable, meaning they can go up or down. As of December, the weighted average interest rate on their debt was 5.6%. Now that can increase. There's also a bit of a conflict of interest here. Affiliates of the sales agents in this offering are also lenders under that credit facility, so they might end up getting more than 5% of the proceeds from this offering. If you are interested in learning about their older debt, then check their senior securities section filed with the SEC. Let's talk about fees. There's a management fee, which is a percentage of their assets, and an incentive fee, which is a cut of the profits. The management fee is about 3.1% of net assets, though it's actually calculated based on gross assets. The incentive fee has two parts, one based on income and one based on capital gains. These fees can really add up, so investors need to be aware of them. Also, Blue Owl's shareholders indirectly pay the fees of any funds Blue Owl invests in. These are called acquired fund fees and expenses. They have also provided a table estimating the total cumulative expenses over various periods with respect to a hypothetical investment in their common stock. For a $1,000 investment, you might pay around $127 in expenses after 1 year and potentially over $1,000 after 10 years. Blue Owl believes they have some advantages. Their experienced investment team, their origination platform, meaning they can find deals without relying on big banks, and their defensive investment philosophy give them an edge. Here are some things that could go wrong. Economic conditions are uncertain and global markets are unstable. This could make the value of their investments go down, and they use leverage or borrowed money, which can magnify both gains and losses. Also, they've promised not to invest more than 20% of their total assets outside the US, which might limit their options, so as always, do your own research. Finally, they have declared some recent dividends, including a second quarter dividend of 37 cents per share and a supplemental dividend of 5 cents per share. Keep in mind, Blue Owl is only responsible for the information provided in this prospectus, and any supplements don't rely on information from other sources. This is the real deal right here. Now, for my take, Blue Owl appears to be navigating a tricky market with a focus on steady income, but some risks are present. Let's assess what this all means. Assessment of company direction. The company is trying to play it safe, focusing on income-producing securities. There are some interesting strategic moves, such as a new advisory agreement and the recent merger. However, there are also issues to look out for related to external management and some conflicts of interest. Strength and weaknesses. The main strength of the company comes from the diversified lending strategy. It originates and invests in senior secured or unsecured loans. Its main weakness is the use of leverage and the amount of fees shareholders are paying the insiders. Notable risks or opportunities. Given that the company is trading slightly higher than the NAV, a rights offering isn't out of the question, and the company is authorized to do so. This can lead to a dilution of current equity. The company has a strong portfolio, but I would be wary of the company and its debt load. Stock price outlook. The company might increase in the short term, but the long-term outlook is mixed at best. There is risk for downside, and the company does not have enough upside to justify the risk. Conclusion. Bias neutral. A reasonable target price range would be $15, $16. Don't forget, this is not a financial advice. Make your own research and come to your own conclusions. Thanks for watching. If you found this video helpful, please subscribe and let me know what companies you want me to analyze.